This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
With us around the table, I'm pleased to say, Jack Caffrey, Equity Portfolio Manager at JP Morgan Asset Management. Morning, Jack.
Good morning.
What do we need to see to get this rally to broaden out into next year?
Well, I think let's break this down into three steps, if you will. The holiday rally is certainly very much in force. As Tom just mentioned, November has been a really good year. I think against the context of what most people would have been putting forth as an idea of what to expect. With the end of, say, tech selling, with the return of the corporate bid, with earnings actually now being positive year on year, you have the ingredients of the next, call it month, 2, 3, of things being able to, I think, move a bit higher. Turning to what gets you a broader market rather than an extraordinarily narrow market, I think is I hate to say it, we stop kicking the can down the road in terms of what a continuing resolution turns into. How do we actually get some clarity on what federal spending might look like for a long enough time that we can then just worry about the election rather than how we're going to finance the election and our government. And then I do think you're going to have a continued tug of war between the earnings outlook and the multiple, where what happens in bond markets becomes really important.
It's interesting that the first thing that you pointed to was the political calendar in 2024. Is it that important for you?
Equity markets want to find something to worry about. And to the extent that most economics students chose to stay away from political science for a reason, we wanted to pretend we understood the math rather than understanding the psychology. And what we come back to, and where I actually have a degree, quote, formally in political economy. And at that point in time, I'm like, why? I'm like, well, I kind of think government writes the rules under which the economy operates. So it would help me to understand who's writing those rules and what they're going to set them up to be. So, paying for all of it kind of matters.
Jack, what do people do that have single-digit returns this year? You've been doing this for ages, and there's those certain years where we're all behind. How do you catch up?
I'm trying to figure that out because I'm behind this year.
Well, you got 3 minutes, so give us the answer. We want an answer now.
Oh, okay. Well, I should have bought a lot more Nvidia. Would have been an important thing, but it doesn't really fit in a dividend growth mandate. I think ultimately it comes back to that question of broadening. A, and B, I think, if you look at a strategy, earnings were supposed to be down this year, they wound up being up. Dividends are up mid-single digits. You can find portfolios of stocks that have dividends that are up low double digits.
Do you fault big tech because they don't pay big dividends or establish double-digit dividend growth?
I don't think you can fault big tech for behaving in a way that they're rewarded. So to the extent that you can have companies that are valued on a price to sales basis, what everyone is telling you is we're not actually asking you to have earnings. So to the extent that you can have an entire, almost 30% of a market, which doesn't have to manage itself from an earnings perspective to a consistent cash return to its investors, those management teams are going to do what they've done and continue to do that. I think dividends offer a real check on earnings and a real return of investors, and let them decide where to reinvest.
Lisa, Nvidia drowning in debt, 1.1%.
Well, this is a cash flow just bonanza, right? And at what point are we pricing in a potential continuation of the pace of acceleration of that cash bonanza into the future? How do you even game out what we're pricing in, given some of the moonshots we've seen?
Nvidia today reminds me a lot of Cisco in the late 90s as having been that defining stock that somehow sat in the middle. So what Cisco was to the internet and the completely network world, everyone hung on what John Chambers would say at 401, where he would shockingly manage to beat earnings time after time after time. And ultimately it came down to when his customers ran out of money to keep buying his servers. Nvidia now sits in that particular position where they can sit there and look at the capital spending of Microsoft, of Amazon, of Alphabet, with some reworked chips, of what China intends to do in AI, what certain countries in the Middle East seem to be doing in order to actually build up their own AI equivalent. And you'll come back to at what point does the investments those other people are making start actually becoming more challenged? What's different now versus the 90s example, where I have to admit there's a difference. Cisco's customers were all debt financed. And so what the Fed wound up doing, draining liquidity, taking down the concerns and the flood of liquidity for Y2K, for people who remember ancient history, is very different than an extraordinarily powerful base of very profitable cash flow generating companies, which for the most part aren't being asked or pressed to return cash to their investors. In some cases, thanks to dual voting stock, that they're not ever going to be pressed.
This is a fascinating point. In other words, it's how long do the customers have open pocketbooks and plenty of cash? And their customers have big open pocketbooks and massive quantities of cash. So how much can you see the moonshot continuing in some of these names that we didn't appreciate perhaps at the beginning of the year?
Well, I think, Wall Street loves an easy story to understand. AI is conceptually really hard to understand, but if everyone wants to do it, everyone is going to keep spending. And certainly right now, the cost of capital is higher, but it's still not all that burdensome against a longer-term history of what money should cost, to the extent that the companies which are really driving that spending either have access to a blank check, if you're in China, effectively from state financing or personal financing, and ultimately coming through. But, when you look through why are people somewhat disappointed in Nvidia, I think this morning it's, okay, that's all you've done for me. Like, what's double digit? What's effectively a 200% gain year on year?
Tripling revenue in a year or something. It's kind of nuts.
It kind of speaks to being a unique company in a unique place and time, but that comes back to, at some point, what have you done for me lately?
And that's where we are this morning. Lisa, I think investors also, they sort of gravitate towards stories they believe are divorced from the cycle because they don't want to talk about the cycle anymore. And this is one of those trends that you can just see out beyond a recession, a year, 2, 3, 4, 5 years down the road.
Well said. It also doesn't necessarily have the cyclical feel, since we're looking right now at something that is a moonshot in a very specific slice of history and has the dominant footprint.
Quickly, Jack, I'm calling the bull market the Ankampur Yardeni bull market. Two fossils from the past, like you and me. And the answer here is this a legit bull market, and are we at a 77 analog where this is the second leg of a bull market? You got a lot of scared people over at JP Morgan, don't you?
You've got some really enthusiastic people, you got some really scared people. That's the beauty of having...
Is it the second leg of a bull market?
We've had a great year this month, and if we go back and look back 2 years, we're still down 2%. So, we haven't really re-entered that bull market because we're still not back to highs. To really make the sustainable highs, you actually need more people playing along than what I call the sacred seven. Not the magnificent seven, because I'm trying to avoid theological belief in terms of growth rate. But I do come back to, what we had was a good growth quarter. It seems like we got that because the inventory supply chain finally got fixed. Companies could actually fill the orders.
Right.
And right now the concern is, orders are seemingly drying up a little bit because you don't have to double order anymore because you actually get your stuff.
John, did you see this percent change on the Standard & Poor's 500?
Looking at it now. Year to date, we're up big time. Month to date, up something like 8%.
8.4.
Amazing. On the session at the moment, we're positive by 0.2%. Jack, you and I have had the privilege of talking together for a long, long time. I just wanted to squeeze in your call on housing, because you've had some interesting calls associated with that part of the economy. What's the call now?
It's certainly, the last several months, my bias has been we're living in the renovation nation. The idea that, with an 8% mortgage rate, people are almost trapped. It's concept trapped in your 30-year mortgage at 2 3/4%. The shame. But you're certainly going to see, I think, some freeing up of housing activity. I do think that comes back to, will the bond traders finally be right and we start getting some rate cuts next year rather than this permanently high plateau that the Fed is talking about, which kind of reminds me of Irving Fisher about 1929, except now it's bonds, not stocks.
This was a clinic. Jack, thank you. Jack
Thank
Caffrey
you so much.
of JP Morgan Asset Management.
This is a joy, and away from the horror of the Eastern Mediterranean, to have Aaron David Miller with us is wonderful. He wrote a book in 2014, which ought to be reissued this morning. He's senior fellow at Carnegie Endowment for International Peace. And Aaron, with respect to our president, and to take your wonderful book here on the end of greatness, I want you to describe how you perceive any given president, but in this case, President Biden, with Mr. Netanyahu. how should we interact? How should our president lead, dare I say, Israel to a better future?
That's a very good question, and the president's been roundly criticized by just about everybody, with the exception of the Republican Party that has sort of emerged as the Israel can do no wrong party, for not restraining Israel, for not cracking down on the exponential rise in Palestinian deaths and the humanitarian catastrophe in Gaza. I'm Pithy, the oracle at Delphi, reading the best of Godin trails, can't tell you how this conflict is going to end. But I will say one thing is predictable, and that is Joe Biden's response to this crisis. For three reasons: his persona, the fact that the presidential model here is Bill Clinton, though a generation apart, both of these men have this preternatural love, I would say, I use the word intentionally, for Israel and high regard for its security. The president reacted to October 7 in a powerful speech on October 10th, which set the frame for his reaction. The second is politics. You have a deeply divided Democratic Party, progressives, and even mainstream Democrats, some of whom are calling for more restraint. But again, 2024, I don't think the president wants to leave himself vulnerable to Republican charges that he's weak on Israel. And the third P, persona, politics, is policy constraints. The fact is, Biden doesn't have any better answers to the three cruel dilemmas that the Israelis face. Number one, prosecute a war against Hamas and eradicate it in a densely populated urban area without endangering and killing large numbers of Palestinians. And then what do you do about the day after? I don't think the administration better sense in the Israelis.
Aaron, I look at the collective memory lost, and it may be as far back beyond 1948 or certainly 1967. We have a youth of America that seems removed from our collective memories of the Eastern Mediterranean. How do either political party corral the youth of America towards an understanding of America's effort in diplomacy in the Eastern Mediterranean?
I think it's virtually, given the generational divides, identity politics, the sort of asymmetry of power where the stronger party, regardless of its motivations or context, is perceived to be the Goliath and the smaller party perceived to be the David. I'm not sure that's possible. I mean, I would argue public service, but then again, I'm old and probably out of touch with this generation. When it comes to foreign policy, I think George Will was right. For most Americans, and I think even for young Americans, they want as little of it as possible. So the fight, the struggle, the focus is here at home. And I worry about that young generation. I have two 40-year-old kids who I think are committed trying to leave the world a better place. They are interested in foreign policy. My bias has become theirs to a degree. I think it's hard. It's really hard.
Lisa, I'm depressed when somebody young is 40. Okay, can I just let you know that?
But Aaron, I am curious how you see this evolving in terms of, we've been all talking about what some sort of humanitarian pause or ceasefire or whatever you want to call it, a cessation in fighting for 4 or 5 days to allow the hostages to go home to their families, to allow for humanitarian aid to enter Gaza. What does that lead to? Do we have a sense of what different camps want after that?
I think you broke the code. I think that's the key question, is what we're witnessing within the next 24 hours when 50 Israeli women and children will be released, hopefully 3 Americans, including a 3-year-old that's about to celebrate birthday. Is this a headline or is this a trend line? Hamas took prisoners for 2 reasons. Number one, to trade them for asymmetrical number of Palestinians released from Israeli jails, 150 in this trade, because this resonates deeply in the Palestinian street. Hamas also took hostages in order to constrain and delay an Israeli ground campaign. The hope is that pressure will mount. A 4-day pause will turn into a 6, 7, 8, 10-day pause. Pressure will mount for what Hamas really wants, which is an extended and prolonged ceasefire. That is going to be extremely problematic for an Israeli government that seems to have no intention of stopping its military campaign. But pressure is going to rise, and we have 2 clocks ticking. The Israeli operational clock, which is ticking much slower, weeks, perhaps months. Biden and the international community's political clock, which is ticking much faster under the pressure of the humanitarian catastrophe in Gaza and the exponential rise in Palestinian deaths. It seems to me this situation is going to get worse before it gets much worse, I'm afraid.
Back-to-back clinics on this program in the last 30 minutes. Aaron David Miller there of the Carnegie Endowment for International Peace. Just phenomenal.
It is a wonderful tradition for us to right-size the airline industry, all that we hate it. Joining us now, Helane Becker, Senior Research Analyst at TD Cowen. Helane, let me just start with the basic idea. When does it get better? When does American aviation, not so much nostalgically, harken back to what we remember, but gets to a new, more constructive model?
Yeah, thanks, Tom. So I think we're in this period of time now for a few years where we don't have enough air traffic controllers. So anytime there's a rain cloud in the area, and a lot of the controllers we have are less experienced than the ones who are retiring, they slow things down, and they do it for safety purposes, but it's frustrating for passengers. You've seen in the New York area especially, but it will occur in other markets, the FAA asking the airlines that serve the market to cut capacity. So we've seen this trend to more seats per departure and fewer departures per day in an effort to smooth things out. And then just in terms of people traveling, I think people are tired of not being able to go away. And you've seen that, right? You saw it in 2022. You're seeing it really aggressively as people travel in 23. And we definitely expect it to continue.
On this weekend, with this weather, what are you focused on in the team at Cowen?
We're looking at the traffic numbers, and we're looking at where people are going. And what we're seeing is an increasing number of people going outside the country, actually, for the holidays with their family. I don't think people may be tired of cooking at home. They don't want to go to a restaurant for their Thanksgiving dinner, so they change their mind and they go traveling. And we're seeing an awful lot of that. And again, I think that's a good thing.
I'm looking right now in some prices to a couple of places, and they've come down really markedly. I mean, I'm actually surprised by how much lower they are this time of the year than last time of the year. There was a story on the Bloomberg talking about how airplanes have been actually increasing capacity in response to what you're talking about, the demand from the consumers, but they're having trouble now filling the seats. Are we seeing the shift that could really change the picture in a more material way for next year?
I think we are, actually. What we're saying for next year is that domestic is going to be normal, whatever that is, but it will be normal seasonal travel patterns, more so than we've seen in the last few years. I call it 4 is the new 3, Lisa. Your boss wants you back in the office 3 or 4 days a week instead of 2 or 3 days a week. So it makes it hard to take that long weekend. Kids are back in school 5 days a week. So again, it makes it hard to just pull them out and go somewhere. So we're seeing that more normalized travel pattern in the domestic market. I think what you're going to see internationally is increased capacity because that's where the demand was. So you'll see fares coming down, especially in the North Atlantic and the Caribbean, Mexico as well. Those are 3 of the biggest markets where we see declines. And then we think there will be a shift to Asia Pacific. Oh, sorry, Tom.
No, I think this is important. Lisa, you and I have been following selected flights, and I just look at one Newark to Paris. It's what everybody takes, and the answer is it's 1/3. You could fly 3 people now business class for what one business class ticket cost 18 months ago.
Yeah.
Stunning.
I look
declines.
at Denver theoretically because some of the snow has started and it's really nice.
Well,
right
you
now.
think it's Paris, it's Denver.
Yeah. That's okay. Helane, I am curious, as we talk about the potential for prices to go lower, where the breaking point is for some of these airlines. We talked about some of the contracts with pilots, with other staff. All the prices are going up dramatically of the work staff. The base costs are going up as well. Put oil aside for 1 second. How difficult is it to make that break point for some of these airlines as prices start to come in?
Yeah, we're going to see margins get squeezed. No choice but to raise your revenue. And it's hard to raise revenue because especially in the domestic market, people will opt out. And you can't I've done this for a long time, as you know, and you can never lower fares to offset volume declines. It just doesn't work that way. And so we'll see margin pressure. And we don't think airlines will make as much money in 2024 as they earned in 2023 as we revert to a more seasonal and normal pattern. I liken it to the cargo industry. Look at what happened with FedEx and UPS over the last year and a half or 2 years.
Right.
Volumes are down and revenues are not up as much. Revenues are down, costs are up, and margins are under pressure.
Well, that said,
why wouldn't that happen?
Do you run away from the industry? I mean, I'm trying to get my airline stocks back to where they were pre-COVID. Good luck with that dream. Yeah. Is there a single best buy, or do you just walk away from the sector?
It's really hard, Tom, because the stocks are at 2020 lows or below. Our best idea for 2023 was United. We had some good success with that most of the year until we didn't. And then we really like Copa, CPA, which is Panama-based. Everybody thinks, oh no, Panama, but there's actually a lot of really good things. It's a $3 billion market cap company. Panama is a sea-level airport, so you don't have the weather-related delays. There are a lot of U.S. expats who live there. They rely on the U.S. dollar. They don't have their own currency, so they can only spend what they earn. The canal would be the largest employer, as you would imagine, and then Copa would be the second largest private employer, followed by the airport. So it's a really well-run, well-positioned airline with a dividend, around a 3 or 4% dividend yield, and that dividend goes up almost every year as the family, the shareholders pay, or the company rather pays out 50% of adjusted net income. So that's a good one to look at. A couple of others.
Yeah, Helane, thank you. We are so grateful that you're here on Thanksgiving. Thanks. And I am wondering, are you traveling on Thanksgiving? Do you ever travel on Thanksgiving?
That's so funny, Lisa. Normally we do, but I couldn't take it this year. I've been on the road every single week since August 1st. And when I looked at all our kids are traveling, they're all gone. My son and daughter are together with my son's baby and his wife, and my stepkids are visiting their in-laws. So it's like, I looked at my husband, I said, no, we're staying home and I'm not eating turkey.
Helane Becker of TD Cowen, thank you so much for being with us.
This is a really important conversation right now. It was important 30 days ago, but it is important into 2025. Earl Davis has had a fixed income, BMO Global Asset Management, and I can't say enough about the controversy of his call that Jerome Powell will stay the moment and keep rates higher for longer. Earl, do you stick with that call?
100%. And that's one of the things we're looking at in the market now. In regards to how many eases are being discounted for next year. We see, we're on our way to 100 basis points of eases by the end of next year, which we think that, I always believe the market, but in regards to the pricing at the moment, but it's our belief that they'll be firmly on hold next year.
You're out of Western Ontario, the land of perfect statistics. What's the correlation of your Fed call, your higher for longer call to the equity markets?
Oh, that's a great question. The higher for longer doesn't matter to the equity markets. Their discount rate's the long-term rate, right? The 10 to 30-year real rate. So what happens on overnight won't impact equities unless they do ease. Then it's just a euphoric buying of equities. But from a quantitative perspective, it's the 10 to 30-year real rate that matters for equities.
When we talk about the 10 to 30-year rate, we were talking yesterday with Michael Collins of PGIM Fixed Income. He said he could see a material further decline in real yields just based on the fact that people are expecting this growth to continue and that he thinks we're seeing the signs of a more material slowdown. Do you agree?
I agree eventually. I think the real rate will stay elevated for a while as long as the economy remains resilient. I know we're getting mixed numbers, but the economy overall is still doing well. Less and less calls for a recession during 2024. As long as we have that, real rates will stay high because that's the counterbalance to the economy doing well. You need to take money out of the growth economy into the savings economy, which is real rates. And to fight inflation, which, it seems like people have forgotten, part of fighting that's keeping the real rate high.
So in other words, you're saying you don't think that the slowdown that we're seeing on the margins is enough to bring inflation lower, and that currently the 0.9 percentage point decline in benchmark rates, the cuts that people are pricing into the market next year, are overstated?
So I'll say two things. It's not necessarily the slowdown that we're seeing, it's the pace of the slowdown. Is growth declining fast enough? There's still a lot of excess demand in the economy. I see it when I still go to the stores and restaurants. Yes, it may be savings, it may be credit that we're seeing at retail sales, but people are still buying. That is excess demand. That's a big driver of the growth in our economy. And that's what leads to inflation. So I don't see it on that part. On the inflation front, we're getting constructive numbers, but we are still very worried about wage inflation and that pass through into pricing.
It's right where I wanted to go. You really center out wage inflation. How 60s are we? I mean, the idea of, forget about cost push, demand pull, and the rest of it. Is it just plain and simple wage inflation that we remember from 40, 50 years ago?
I think we're getting there. The difference between now and the 60s or 40s and 50s years ago is the amount of unionized employees. It's significantly lower now than it was before, but that trend is increasing. And what happens when that trend increases, and we're seeing the wage increases, UAW, UPS, you look abroad in Canada as well, what happens is the people who are non-unionized have to get wage increases. And we saw that with Honda and Toyota. So we're not quite 60s, 70s because we're not as unionized, but that trend is increasing, and the wages will remain a pressure on inflation. And I think it leads to secular higher inflation, 3-4% instead of 2-3%.
So what's your highest conviction, Earls, heading into next year at a time where people seem to be moving in the opposite direction, celebrating soft landing, celebrating maybe the return to the old normal? Where's your conviction lie?
The highest conviction is that there's no eases until at least Q4. So that means just by shorting 2-year bonds or any part of the curve, you make money if nothing happens, because the overnight rate's still 5.25, and we saw where 10-year bonds are right now, right? So that's negative carry trade to own those versus overnight. So highest conviction trade is no eases, Fed on hold till at least after the election.
Wow, Fed on hold until after the election. Oh, that runs counter to a lot of people. What do clients say when you tell them that?
Well, first I tell them following a winner is a loser's game, So if we try to follow what the crowd's doing, we're always coming in second. So we base our views on tailwinds, on fundamentals, on quantitative numbers. And that's what that's what has proven to be successful in the past. We just show our results and we say, what's our markers? So for example, where would we advance our eases? Where do we start believing what the market's saying? For us, the key number to look at is unemployment rate above 4%. As soon as it gets above, then, I think the safety's off, so to speak, in regards to eases. We're not even closer. We're at 3.7 still, so we still have a ways to go. And I think the Fed would like to see it closer to 4.5 before they start easing. So that's our trigger, and that's what we tell clients what we're looking at and what will help us change. And they know our results, and they know this is the most volatile year in fixed income, and we're outperforming in it.
It's nice to get an original thought, Earl. We appreciate it. Earl Davis there of BMO Global Asset Management.
What are we going to talk to Mandeep Singh about? Not stuffing.
Take your pick.
Got like 8
you can
things.
have
Nvidia,
OpenAI or Nvidia.
Which would you like to
one?
go with, sir?
To be honest with you, I'd prefer to talk about Nvidia because I think it's more material to
Let's do that right now. Mandy Sing joins us here on Nvidia and what we saw yesterday. What is the legs on this, Mandeep? I mean, we all get the moonshot and units and the fervor, and I saw the 240%, blah, blah, blah. Do you look at it as a 3-quarter thing, or can it be a 30-year thing?
I mean, look, we are witnessing the biggest data center expansion right now, and data center IT market was about 8 to 10% grower historically. And when you look at the numbers that Nvidia is printing, clearly there is insatiable demand. Yes, they will be affected by China restrictions, but they're still under shipping demand, and that was the message. And this is a near monopoly at this point of time. The question that you have to ask yourself is, will it remain a monopoly like Intel was over the last 25 years in the CPU market, or will there be more players that can develop chips? And right now, customers that are buying these chips are very concentrated. It's the hyperscalers that are buying, 50% of NVIDIA's capacity. Will they continue to do that,
Right.
for the foreseeable future?
Okay,
That's
well,
the question.
you're an expert on this, and I guess Altman's back at OpenAI. How long does it take to make a competitive chip?
Well, so that's what NVIDIA has showed, that they can pivot much quicker. They can ship products much quicker than anyone else. Look, AMD and Intel have the capability to make a GPU, but it's not as productive and efficient as an NVIDIA GPU is. And that's what, we are seeing. That's why I say it's still a monopoly. And until you see proof that companies can train as effectively their models on alternative chips, I think NVIDIA will continue to have this kind of ASP growth, which we saw last night.
Mandeep, one aspect of the earnings report that I thought was probably most interesting was the drop-off they signaled in Chinese demand for their GPUs, for some of their products. And this comes at a time where they're still able to beat expectations on revenue. They can still ship those chips elsewhere. What does that tell us about both what's going on in China, but also more broadly, what's going on with just the glut of demand?
Yeah, look, there was certainly some pull forward in China because they anticipated these restrictions, and you could argue NVIDIA was probably over-earning in that region. But there is that demand, that they can ship their chips elsewhere, and that is what gives, I think, the confidence that this company is way ahead in terms of not only just developing a GPU, but bundling it. They highlighted networking is a $10 billion run rate business. Software is a $1 billion run rate business. They have the perfect mousetrap right now in terms of bundling these chips to train large language models, and that's huge.
All right, so Mandeep, we were talking about OpenAI and trying not to talk about OpenAI and the relevance of that to this story. How much is there a relationship in terms of Microsoft's desire to create some sort of rival chip with respect to the AI development more broadly, and what the future is for OpenAI as an independent agency?
Yeah, look, OpenAI and NVIDIA are the face of generative AI, if you think about the trend that has played out this year. And I think with OpenAI going through this turmoil, Microsoft driving those changes has steadied the ship. But I would be surprised if they can, ship out the next version of GPT as quickly as they intended to be, because there will be some talent loss as a result of this. And I think Sam coming back to OpenAI may drive some people out, and I can't imagine things will go back the way they were last week.
What do those people actually do, Mandeep? I'm serious. Do they sit at a desk with what? A Sun Spark station, a Mac? What computers in front of them? And are they doing the coding like the coders do at Bloomberg? Is it just as romantic as that?
I mean, look, this generative AI wave is built on a transformer model, and that is built on, ingesting large amounts of data. There is a human feedback element to train these algorithms and put those guardrails. And training is a constant process. That's what we learned from NVIDIA last night, that you're not one and done with training. You're constantly training your model. That's why you need the GPUs and the data center build out. So there's a lot that's going on in terms of understanding the algorithms, and then obviously putting the guardrails to make sure the results are correct.
And Mandeep, just a final question from me, and certainly I would never criticize Satya Nadella. I think I've said on this program and in the last 24 hours, one of, if not the best CEO in corporate America. But clearly some missteps along the way here. Mandeep, what do you think the lessons of the last week will be for him and for Microsoft?
I mean, when you make a $13 billion investment and, take a 49% stake in a company, you take a board seat as well so that you know what's going on. I think in this case, they were blindsided by the developments, and he mentioned that. And clearly, I think that was the lesson for Microsoft here.
Mandeep, thank you, sir. Mandeep Singh of Bloomberg Intelligence.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.